Hello, good afternoon. Today on the final bar, we'll wrap up this week's price action with a Friday rally that certainly seems to confirm a bull phase and a potential further upside in the coming weeks and months. We'll hear from our guest, Tom McClellan of McClellan Financial Publications, hear his take on where he sees the markets going using a number of different techniques. We'll also level up, upgrading our use of the product on the sector summary page. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of the Final Bar here on Friday, November 1st, 2019. My name is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a very chilly Redmond, Washington. Really appreciate you joining us today. This is, our fourth or fifth week or so of doing the show. Really appreciate everyone coming along this ride with us. As always, we really are interested in your feedback as we keep trying to make this closing bell experience better for you. So shoot us an email, would you, at thefinalbar@stockcharts.com. Let us know if there's anything we could do to make this 30 minutes at the end of the trading day more helpful to you. Really would love to hear it. Before we get into a recap of the markets and wrapping up the week from a technical perspective, just want to remind everyone next week, a week from today, I'll be at the Las Vegas Traders Expo down in Las Vegas, obviously. This is November 7th through 9th, so next Thursday through Saturday. I'll be speaking Friday evening around dinner time with a presentation called The 5 Modes of Mindful Investors, where we'll talk about some of the behavioral biases that get in the way of good decision making with your investments and how charts can help you minimize the impact of those negative emotional drivers. So the website on the screen will get you to some more information on the show, allow you to sign up for it. They also have some streaming options if you're not able to get to Las Vegas. If you do, I hope you can say hello to me after the presentation. We look forward to meeting all of you. So for the market recap, sort of unwinding today's price action, we've talked now for a number of weeks about just, bullish versus bearish and what we're seeing at the top level indexes, but also looking below the levels below, looking at sector movements, looking at cap tiers, looking at styles and all the different ways we can try to understand what's driving stock prices up or down. And today's price action with, what seems to be a clear follow through to the upside, the S&P closing around 3066, 3067, a new closing high, new price high today. Over the last week, we sort of broke above resistance from July, sort of got to that higher point. But then for a couple of days now, we've sort of floundered a little bit, not really followed through, sort of kept trading below that resistance level. Today certainly seemed to be the upside follow through that some may have been waiting for. And if you had not sort of gotten on the bullish bandwagon, it would be hard pressed, I think, from a technical perspective to not see, some clear bullish signs from a lot of different charts, especially the chart of the S&P 500. So, a lot of times I'll get the question when the market goes to new highs, when a chart goes to new highs, we always talk about look at where we're at, look left on the chart and find key support and resistance levels to give you some sort of guidelines. When we go to new highs, right, when we're at a point where we don't have a reference point, when we look left, we see just open space, right? So there are a number of things you can do. There are a number of projection tools that people use, like Elliott Wave is probably the most common that I've seen. Some of the DeMark indicators might come to mind, different sort of, and Fibonacci projections, just ways of trying to anticipate based on, some of these previous moves, how they went, and then trying to use that to extend the current move and sort of come up with some sort of upside target. Some of the other presenters on StockCharts.com are probably way more fluent or I guess have a bigger appetite for those sorts of things. I think maybe it's sort of the institutional background that I have, but I found that institutions, when we have this sort of environment, you really just fall into trend following mode because if it hits some level, I'm not going to naturally want to sell that if the price keeps going higher, right? And I think if you have targets that a lot of times will allow you to, or maybe enable you to sell too early because the market will just keep going higher and you've sort of missed it. So for me, I certainly am mentally in trend following mode. And as long as the trend is up, I'm going to want to own stocks, to be honest with you. Here's what today looked like on the far right side versus the rest of the days of this week. So this is Monday through Friday. So, now you sort of get the last 4 days in perspective, sort of this relative sideways choppiness. A little bit of distribution over a couple days, but we rallied into the close yesterday, a big gap up, and then really just chipped away higher, finishing at the close, which, the last 30 minutes, more accumulation than distribution. So again, all signs there really point to higher movements. I think that's certainly what we've been seeing here. Let's look at the Mindful Investor Live chart list and look at some of the charts that could be of interest to you. This is the breadth by cap tiers that we've talked about before. Here's on a closing basis. Boy, it looks more obvious if you look at it on a closing basis just because we've jumped so much higher now. But here's the breadth, the cumulative advanced decline lines for the S&P, for the broader NYSE, for the mid-cap index and the small-cap index. And I've color-coded all of these green, signifying, or I guess recognizing that they've all gone above their highs from last month. So all four of these sort of confirming the upside. So there have been times, maybe earlier this month as an example, where it felt like the breadth really hasn't supported this. But certainly from the way I'm looking at it, you feel like a lot of upside follow-through with some of these breadth measures. Here's another one we've looked at. This might be a little more cautionary, but it really depends on how you think about it. I don't know if you could certainly call it negative, but maybe it's just a little mixed, right? So here's the S&P going to higher highs. Here in green, we're highlighting the middle of June to the middle of October, sort of similar patterns with the market going to new highs or close to new highs, increasing number of new highs on the New York Stock Exchange, on the S&P 500. You can see now the challenge I have now is the beginning of September, you had less and less new highs as the market was trying to push higher. And I'm seeing sort of a similar pattern here, right? So we're at new highs in price. We're getting a downward slope in in the new highs, right? So that's all that tells you is less and less stocks making new highs potentially as this is going higher. Now, there are a lot of things that this could mean. I mean, and again, there's no perfect measure of breadth. I would argue there are a lot of different ways that make different assumptions and try to summarize it. But so I like to look at each of those individually, then try to sort of paint the mosaic all in one. At a sector level, let's look at what happened, toward the end of the day here. So energy, the top winner, followed by industrials, financials, and materials. So usually call this the MEI tree, the materials, energy, industrials, all at the top. Financials as well. We're going to look at a chart of the XLF in a minute here, but certainly seeing strength from those areas, really more of a rotation to cyclical strength. At the bottom, you have some of the traditional defense like consumer staples, utilities, real estate. So this really sort of mirrors what we saw at the big picture with the offense leading and the defense lagging. There are a number of good moves on the global side. So Hong Kong, China, the China A shares ETF, South Korea, a lot of Asian markets here up significantly, up 2% almost, much more than the U.S. market, which is worth noting. A lot of things sort of, everything was up from the universe that I look at, but some sort of lagging behind, and it's sort of the larger European markets that are sort of at the bottom of the list. From the S&P there, 0.9% at the time we took it. Also encourage you, we're going to talk in a minute, wrapping up the week, looking at industries, but a lot of movements and a lot of materials groups that really jumped up higher today. So non-ferrous metals, also aluminum stocks. So if you're not familiar with those groups, a lot of times these industry rankings can surface groups and names that you might be less familiar with. So I'd encourage you to check that out if you've not done so already. So that's a quick recap of today's price action. Let's think a little bigger picture. This is the Wrap the Week segment, and what we try to do every Friday is try to wrap up the entire week from a technical perspective. And again, the goal of the show every day is to connect the short-term movements of the day with the longer-term trends and make sure that we orient ourselves correctly. It's a natural time at the end of the trading week. We now have the weekly close in place to really take a step back and just think about the big picture. Where are we now versus where we were 1 week ago? Any meaningful changes in those trends or meaningful signals to be paying attention to? So we start with the long-term weekly chart of the S&P 500. This is just looking at the weekly open, high, low, close. And again, based on any measure, this is just using the 40-week, which is similar to the 200-day moving average, then the 150-week, which is a much longer term moving average. Clearly we've gotten to a new closing high. Last week at this time, we're, back above 3,000. We're retesting the high from over the summer. And the question was, do we get follow through this week, or have we hit resistance? And this would be a, 1, 2, 3 triple top. And it's a selling opportunity as we go lower. And again, this week's bar sort of confirms the former. It tells you that, we have hit resistance. We've now eclipsed it. So, on a lot of individual charts like Apple we talked about yesterday, we'll look at that in a moment. But just the broader S&P 500 certainly feeling a resolution to the upside. And again, until you see evidence suggesting some internal weakness, certainly seems to be long and strong up and to the right, healthy uptrend for stocks overall. Let's look at the sectors real quickly. We'll do it in the form of the RRG. There we go. So this is looking at the relative rotation graph. We don't look at this too often, so I want to make sure we revisit it as wrapping up the week, just thinking about where we've come from. So, you can see utilities, real estate, staples. Look at how quickly they've come down. This is not super quick. Over the last 4 weeks, we're seeing this rotation, but consumer staples first to come into the weakening quadrant, now sloping down and to the left, which, really representing weaker trend and weaker momentum, meaning it's, the rate is really going lower. Real estate this week has now gone into the weakening quadrant at all as well, and also aiming down and to the left. Utilities, same direction, and just a little bit behind them, but overall a big rotation away from some of the defense. And what I'll show you here in a second, I'm just going to zoom out for a second. As we put that in motion, you can see over the last couple of weeks, as the markets sort of threaten new highs, I'm sort of moving it on the right side here, you can see how on the left, utilities, real estate, staples, all rotating lower. Other themes to pick out, look at the XLE on the far left side of the screen. Look how that's rotated into the improving quadrant and sloping up and to the right, sort of that northeast direction, which is pretty positive, according to this. XLI, industrials, almost to the leading quadrant here. And then you have the XLF, which is now in the leading quadrant. So out of all of these, what is the most attractive? That's actually a little bit of a debate, I would say, at the moment, because the XLF is probably aiming in the best direction, aiming northeast. The problem is it's right by the zero level, essentially meaning it's not too far from the market average. This is the S&P right in the middle. It's the benchmark. So it's not giving you a lot of movement relative to the S&P. Anything that's further away from that zero level means it has a much bigger move relative to, on a relative basis, versus the benchmark, right? So it's giving you more opportunity because it's more differentiated. So industrials, financials, certainly two of the stronger, more interesting movements. XLK down here, which is, one of the stronger ones, just being furthest to the right, but starting to go up and aiming toward that leading quadrant. So those are the three that are looking most attractive on the RRG readings on the weekly basis. And then the XLU, the real estate, and staples all sort of rotating to a position of relative weakness. And again, this is not based on the price, but just on the relative movements. Let's look at just a couple of the sector charts just to think about how they fit into the big picture here. So this is looking at a candle glance of the S&P sectors. We're going to refresh it, jump into the XLF. So this is one of the key charts that we've talked about. This has been on the 3 and 3 a number of times. And again, this resolution now to the upside, this is today's price action, completing a transition, I would say, out of this resistance range. This is going back to last March of 2018, February 2018. This is like a 2-year base. You can see the lows here, the big low in the end of last year as the market bottomed out, and then the higher lows all around. It's really this huge basing pattern, a big base, and a number of market practitioners over time have said the wider the base, the higher in space. And so the fact that it's a 2-year basing pattern on the XLF now resolving to the upside, really suggests a strong move for financials. So overall, that's a pretty attractive pattern, to be honest with you. The XLU is here. We've talked about this pulling back to the 50-day. And again, the challenge is the relative strength here. So you saw how on the RRG chart, it was starting to rotate lower. That's because of this right here. So even though the price is holding up okay, and if you didn't think of it on a relative basis, probably looks pretty good because it's holding up all right. But look at how the relative strength has rotated lower. So as things like the XLF, industrials, other things have started to emerge in a position of strength, healthcare maybe as well, you have relative weakness on something like utilities, which is something potentially to be concerned about. We talked yesterday about Apple, and I just wanted to share the chart of this. This is a chart that's obviously, along with many names, resolved higher, outperforming the S&P by a couple of percentage points up, 2.8% today on the close. You can see this again. Yesterday was, is this holding up, hitting resistance, and is that it? And boy, today we certainly seem to have the follow through on here. Some of the names like Apple are in the overbought region. For me, that puts it on the radar, thinking, is this a time when you take profits? Is this the time you watch it? I would say at this point, just based on how things have moved, if you look on the chart of Apple, like back to mid-March, it's kind of a similar pattern. You're breaking out of resistance, overbought conditions. In this case, it went above 80, extremely overbought. But I mean, that was, there was another 5-6 weeks of higher moves after that because it was such a significant break higher, such strong momentum. So I would argue, potentially the same sort of thing that we've seen there. In a little bit, we're going to talk about in a level up segment. We're going to talk a little bit about more about sectors and industries. So I intentionally avoided that. We're going to get back to that in a little bit. We're going to take a commercial break here. We're going to come back with my guest, Tom McClellan from McClellan Financial Publications, longtime contributor, some really good charts to share with you. So I'll see you back here in 1 minute.
Today's market volatility provides savvy traders and active investors with an abundance of profitable opportunities. At the Traders Expo Las Vegas, November 7th through 9th, over 75 of the most respected traders in the world, including Dennis Gartman, Tom Sosnoff, Todd Gordon, and Tom DeMark, will explain how they're adapting their strategies and share the specific trading opportunities they've identified in equities, options, forex, futures, cryptocurrencies, and more. Claim your free pass to join them at tradersexpo.com.
Hello, everyone. Welcome back. This is your host, Dave Keller. Thanks for joining us, as always, on the Final Bar. Really appreciate you tuning in. I want to welcome my guest, Tom McClellan from McClellan Financial Publications. Tom, thanks so much for joining us on the show today. We appreciate it.
It's great to be with you, and I welcome you again to the Pacific Northwest. It's nice that you've moved out here with us.
So far, we've had plenty of rain now. I'm getting used to that. We're getting some good cold here, so I'm enjoying it. It's a good fall experience so far. Not too bad. Okay. You sent 3 charts ahead of time. We really appreciate it, Tom. And the first one is looking at the S&P versus emerging markets. I'm really interested to hear what this is telling you.
Well, this chart was a subject of my weekly Chart in Focus email series. It's a once-a-week article on whatever I feel like talking about that's of interest or that's happening right now. This is useful because EEM, the big emerging markets ETF, generally moves along in step with the stock market, but occasionally the two of them will disagree. And it's when they disagree that you get useful information. Usually that's in the form of a divergence, like some of the ones I've labeled in this chart. In this case, the disagreement was that EEM broke its downtrend line ahead of the same line being broken on the S&P 500. We saw that same behavior coming out of the December 2018 low, where EEM broke its trend line first, and then the S&P 500 followed suit later on. So we're seeing that now. This is showing strength. And the reason why this is important and matters is that EEM, the stocks that make it up, they are incredibly sensitive to financial market liquidity. So they're like the canaries in the coal mine that'll die before the coal miners will. And when you see it starting to suffer, or when you see it starting to do better, that is a tell for the state of the liquidity stream. And right now it's saying liquidity is really strong. I should note that this chart is not quite up to date. It's current as of Thursday. It doesn't have Friday's data in it, and the EEM is up another 1.5% to a higher high. S&P is up to a higher high. So one thing, whenever you look at a chart like this, especially in an article from earlier this week, you got to kind of mentally draw in the most recent data. If you go to the next chart, there's more insight about EEM. As an exchange-traded fund, the number of shares in the fund can change, and it does all the time. It goes up and goes down as more people want to own it. The sponsoring firm has to issue or redeem shares, and they either buy the underlying or they sell the underlying to keep the net asset value and the share price real close together. EEM has broken its trend line. It's busting out to higher highs, but so far there's no investor interest showing back up in it. The number of shares outstanding is remaining constant. And that's a tell that says the public is not yet buying into this. At the point when we see shares outstanding starting to rise rapidly, then you know that the game is almost at the end. You can track this data. You can download a historical series. You just go to the iShares website and pull up the page for EEM, and then there's a download link that gets you a spreadsheet for it. So right now it's saying this is still early. Everybody's still asleep. Nobody's caught on yet. The EEM is starting to act strong.
Very interesting. And then just before we were coming on, we were talking, you shared this this third chart, which is looking at the traditional version of the McClellan Oscillator, which I know you're clearly very familiar with. Can you just very quickly, how do we think of this and what is it telling you right now?
Well, this is the indicator that my parents created 50 years ago, back in 1969. And I want to point out again, this chart is not up to date. It's missing Friday's data because you guys are going to wait until you get the final breadth data posted into your database. So this is showing what happened through Thursday. We had a little minor dip below zero, to just barely below zero. Crossing below the zero line can be a negative indication. And it stopped me out yesterday, but I'm back in today because it's bursted back up through zero, up to around plus 50 on a preliminary basis. When it does that, when the oscillator does that, dipping just barely below zero and then popping back up above, that's what the late Kennedy Gammons used to call a buy spike, except he was from Tennessee, so he called it a buy spike. And it's a very, very bullish indication because it says the bears had a chance. They took it below zero. The bears had the chance to try to get some yardage, and they turned around and failed. And so it's a great low risk entry point. It says that there should be more up to speed, more higher movement in the days ahead. And I want to say one last thing about making sure charts are up to date. You were showing some charts earlier in the segment about new highs. And again, that's end of day data. And it's even at 1 o'clock, which is the Pacific time, which is the end of day, or 4 o'clock Eastern, the end of day data is not always up to date. So the New York Stock Exchange new highs looked like they were making a divergence, but that got rehabilitated, and that chart's off the Group W bench. And there's 181 new highs on the NYSE today. So that divergence that looked like it was there now goes away.
You know, and it's interesting. There are a lot of parallels between this chart we're showing now and the chart you just mentioned that I showed earlier with that potential divergence. And I think that's maybe what we've both seen. Right? You said you felt some potential internal weakness, but boy, if you think of today as the last thing we've seen, both of those things feel like they've sort of resolved higher, I guess, right? What I'd love to go back just thinking about that first chart you showed us, which was the S&P versus EEM. When you've always done a great job of sort of showing these historical patterns, how they relate to previous breaks. I'm curious with a chart like this, at what point would you think maybe it was incorrect or think that the bullish call here was wrong, didn't work out? Would it be a change of that pattern of the divergences that maybe did not play out, or would it just be EM or the S&P are both breaking through support? Or how would you kind of think of it from using this chart?
Great question. And as a former pilot, you think like a pilot. You're always thinking, when my engine quits in the next 5 seconds, where am I going to?
Exactly right.
You're always thinking that, even throughout the entire 3-hour flight. You're always looking for where's your emergency landing zone. If this chart were to suddenly show a divergence appearing, like the other ones that I highlighted in red, where EEM makes a lower high, which it's not doing, and the S&P makes a higher high, that would be a problem. It could fail on its own. If they could both drop back below their broken downtrend lines, and that would be another mode of failure. We're not seeing that yet. For now, it's still looking bullish. And I want to also emphasize EEM is still below highs it made earlier in 19 and still below highs made in 18. And so some might say, well, that's a big long-term divergence. That's not the time frame over which these divergences tend to matter. You need to focus in on just divergences that are maybe 2 to 5 weeks in duration, because that seems to be the sweet spot in terms of how they matter. Stuff that's long ago in the past, a year and a half ago, you can forget about that in terms of the message that you're going to get from this indication.
Got it. Tom, listen, thanks so much. Stay warm, stay dry. Thank you for sharing 3 charts with us. We'll hope to have you back on again soon, all right?
Nice to be with you.
Ladies and gentlemen, I want to thank Tom McClellan for joining us. 3 really interesting charts. And I tell you what, we've talked a lot. I think of Tom as being a very detail-oriented investor and analyst, and a great reminder to pay attention with charts, especially breadth charts. A lot of things will update at end of day based on a lot of data sort of being compiled and everything. So make sure you know the updates on the charts you're looking at. You don't want to draw a wrong conclusion based on the data. We have a brief moment for a level up segment, which I just want to share with you very quickly. We've talked a lot of times on this show about diving into a sector, looking at sector movements, sector returns, but then trying to understand them maybe a level deeper and understanding where the movements come from after that. So I wanted to make sure that everyone's familiar with, in terms of a level up segment, the sector summary page. Two ways you can get to it. On the upper left of the chart, of the page, you can see charts and tools. You'll also get a spot from your dashboard to get there. This is looking at the 11 S&P sectors. It'll be sort of different ways, but usually comes up showing you the percent change. So this is energy up the most today, real estate down the most today. We also have scooter rankings for the sectors. Now, these are actually connected to all the different ETFs. So the order of these is what's most important, because it shows you relative to the other sectors what's strong and what's weak. Now, a really cool thing we just added that I wanted to make sure that you saw is this allows you to actually drill in a little further. So if you click on technology, you now have the technology industries below that sector. And we also have the ability to sort these on a sector basis. We actually just in the last 24 hours completed the process of adding scooter rankings for the industry indexes. These are the Dow industries that myself, Tom Bowley, others use on our shows. We actually have scooter rankings. So this is actually taking a universe of about 100 industries, rank ordering them just like we do with large cap stocks. So you see computer hardware is the number one group. You can then click in there and look at the stock rankings within that group. So using the sector summary page, you can start from the 11 sectors, go into the industries that drive it, and then go into the individual names that show strength and weakness. You can also go right to the industry summary page, and this was just added right about when we went on air. So this page also has the scooter rankings indicated on these. So this is actually sorting each of the industry groups within each sector. So within comm services, you can see the 6 industries and how they're rated. You can then drill into the names there. So if you've not used that before, we have additional ways now we've given you to try and drill into sector and group movements. I hope you're able to do that. Want to finish off the show today with the 3 in 3. As you know, at the end of every show, we like to wrap up with 3 charts in 3 minutes. These are 3 charts that if you're not familiar with by now, I hope you are at the end of the show today. Make a point of saving these, recreating them, putting them on your login, and watch these over the coming weeks. I think these are going to be really key ones to pay attention to. The first one is that daily chart of the XLF. This is going back 2 years. This is indicating that resistance area, and we've now resolved that higher. We talked in a little more detail about that earlier in the show, but I just wanted to highlight we've now broken above that level. The ultimate line in the sand is the high, the all-time high here from the end of January of 2018. So if we can eclipse that just above 29.30 or so, that would be a new high for the XLF, which would talk about a dramatic return to strength for something like the XLF. The relative strength is what's really interesting to watch as well. I often look for new 3-month highs or new 65-day highs, 13-week highs as an indication of relative strength. We're really teasing that. We're testing it right now. So if you'd see that relative strength line break to new swing highs, break above this resistance level, that would really sort of confirm not only have financials recovered on a price basis, they're actually starting to emerge as leadership on a relative basis, which would be a big change. One of my guests last week, Greg Gunther, talked about biotechnology. He actually used the IBB, which is one of the biotech ETFs a lot of people follow. But I wanted to point out, he actually tweeted earlier about the follow through, the upside follow through the trend line he had indicated. So I'm sort of taking my own version. This is a chart of the BTK, the biotech index. If you take the high from April, connect that to the high in August, lines up pretty well to the high we had a couple weeks ago. We have now broken through that, tested the trend line, and now resolved higher. And with today's close, it pushed us above the high from September. So we now have a new closing high for the last couple months, have now rotated above the trend line, rotated above resistance. Greg talked about that being a real sign of relative strength, a real sign of further upside. If you missed his interview, just go on YouTube on our YouTube channel, look for Greg's episode, and you'll be able to dig into why he thinks that's such an important chart here. The final one is small versus large. This is the IWM, the Russell 2000 ETF, versus the spiders, the SPY, which is the S&P 500 ETF. Every time we've brought up this chart, it's sort of one of the few charts we look at that's going down and to the right, while everything else seems to be going up here. So it's a very different view. But look at how we've potentially turned. And again, it's so early to say that that's the case, but it's certainly something that I'm watching. So we had a double bottom, or maybe a little bit of a higher low. We've then traded back above the 50-day moving average. I'm looking at this line, just like with the XLF, you saw the rotation to new highs. If that would go above there, that would be a complete change, with small caps emerging as further leadership, more than what we've seen up until now. That's our show for today, Friday, November 1st, 2019. I want to thank you all so much for watching this week. Please send us any questions or feedback to thefinalbar@stockcharts.com, or on Twitter at FinalBarSCTV. We really read every message that you send us. We'd love to get more feedback and more questions. Have a great weekend. We'll see you next week.